The vault door stands open. No one enters. The corridor beyond it holds nothing that moves. The rate has been held. It has been held for longer than most expected. No adjustment comes. Capital does not wait for permission. It flows toward the places that yield. It does not ask why. Savings held in place lose ground each month. The loss is not announced. It accumulates. Asset prices rise. The mechanism is patient. It does not require a single decision to sustain itself. The retiree's account does not grow. The institution continues operating. Both conditions are normal. Funds move from low-yield instruments into equity markets. The shift is structural. It does not reverse. Pension obligations remain fixed. The yield that was promised no longer exists at any safe address. Risk tolerance rises across the system, not by choice, by elimination of alternative. The floor has moved. Insurance reserves accumulate obligations. The assets held against them yield less each quarter. No alarm sounds. Residential property absorbs the displaced capital. It has no mechanism to refuse. It simply receives. The renter pays more each year. The owner's cost does not change. The gap between them widens without intervention. Corporate borrowing expands. The cost of debt falls below the cost of equity. Capital structure shifts invisibly. Share buybacks increase. Employment growth slows. Both are rational responses to the same price signal. Wealth held in equities compounds. Wages held in accounts do not. The divergence requires no catalyst. The Fed holds its position. No member votes to change. The rate is not wrong. It is simply unchanged. Municipal bonds lose their appeal. Cities borrow at higher relative cost. Infrastructure defers to the same pressure. The yield curve flattens. Lending margins compress. Banks hold more. They lend less than the model suggested. Private equity expands into markets it did not previously enter. The mechanism is not ambition. It is vacancy. The small saver has no options that match inflation. The institution has no obligation to provide one. Institutional capital searches for yield across borders. Emerging market assets absorb the overflow. Valuations follow. The policy is not permanent. It has simply not ended. The difference between the two is invisible from inside the system. Leverage in the system rises. It does not announce itself. It accumulates in collateral chains no single actor sees whole. The regulator observes. Its mandate does not include the rate. Its jurisdiction ends at the rate's edge. Those who study these conditions often find that the weight becomes most clear only well after it has settled. Those who return to this account will recognize the pattern continuing. The real estate investment trust absorbs capital that once held sovereign bonds. The substitution is quiet. No one announces it. The first rate increase is announced. The bond market reprices across maturities. The adjustment is not gradual. Assets acquired at low rates now carry higher implied cost. The balance sheet does not change. The context around it does. Equity valuations correct. The correction is not catastrophic. It is proportionate to how far the floor had drifted below. Those who borrowed to buy assets now carry that debt at a higher cost. The asset may still hold value. The carrying cost does not. The institutional investor returns to shorter duration assets. The capital that entered emerging markets begins to recede. Developing economies that absorb the overflow now face outflows. The mechanism that delivered capital removes it by the same logic. The correction in asset prices reallocates wealth back toward those who held cash reserves. They had waited without reward. Now the wait ends. The household that moved into equities to survive the low-rate era now exits at a loss. It entered late. It exits early. The central bank reviews its models. The models did not include the full distribution of who held which assets. The gap was structural. The distributional effect was documented in academic literature from the first year. The policy continued for 4 more. The wealth gap, measured in asset ownership, widens through the period without a single actor choosing to widen it. The system requires no villain. The Federal Reserve's mandate contains no clause on wealth distribution. It was not designed to address what the rate does to ownership. The rate normalizes across several years. Each increment is measured. The system adjusts to each step with visible strain at the margins. The housing market cools. Transaction volume falls. The capital that entered finds fewer exits than it anticipated. Institutional investors begin reassessing duration risk held since the low-rate period. Some positions are large. Unwinding them moves markets. The period is called an era in retrospect. While it lasted, it was called policy. The distinction arrives only after. New frameworks are proposed for central bank mandates. They are studied. They have not been adopted. The gap between study and adoption is wide. The capital redistributed by the rate policy has settled into ownership structures. Those structures do not dissolve when the rate rises. They persist. The vault door is still open. Nothing has been returned. The corridor is exactly as it was found.